Hello, this is Mike Wade, Chief Option Strategist for Tom Gentile, and welcome to this video featuring Tom's tools and yours truly. Stock and options trading has large potential rewards, but also large potential risks. You must be aware of these risks and be willing to accept them in order to invest in the stock and options market. Don't trade money you cannot afford to lose. I'm not offering any buy or sell recommendations on anything whatsoever. Please don't construe anything I'm about to share with you as advice. I'm a trader just like you. All prices are in US dollars unless noted otherwise. And of course, feel free to read the balance of the disclaimer at your leisure. Okay, so in this video, I want to talk to you about safe stock trading practices. In Tom's community, we don't normally talk about trading stocks, but a lot of people trade stocks for a lot of reasons. They have portfolios, they collect dividends, they do a lot of work in building portfolios of stocks they really like. So obviously what can happen with stocks is that they can actually drop and drop fast. Here's an example on Beyond Meat. They came out with their IPO, they had 2 earnings announcements, and the stock was really off to the moon. People were very excited about this meatless meat. I've actually had it. I like it a lot. I think it tastes good. I'm not sure that it's very healthy, but I do like the taste of it. But if you were to buy 100 shares of this stock right here when it touched 240, you'd spend $24,000 for 100 shares of stock. Now, just a few months later at the next earnings announcement, you'll notice that the stock had dropped from 240 all the way down to 100, meaning that your position's value would have decreased from 24,000 to 10,000. That's a $14,000 haircut. I don't care if you're making dividends on that. So in this video, I want to talk to you about using puts to protect your long stock. Another way to think of a put is equal to insurance. So for example, up here, I could have very easily bought a 240 put that would enable me to sell this particular stock, Beyond Meat, for 240, even though it might be worth 100 right down here. So that's a put, that's protection. It's also called a married put. And that's what we're going to be talking about in this video. So we're talking about trading stocks directionally with protection using Tom's married put ranker. Now, one of the things this ranker does is not only does it help you construct safe stock trades by marrying puts to the stock, but also searches for directional probability. So you can run a scan and it will tell you which stocks have the highest likelihood of doubling your money. And then once we have a married put, it's important to understand how to roll those puts up and then strategies for either rolling down the puts if you want to hold on to the stock or closing out the position using your insurance. So let's hop into the software and let me show you this cool ranker. I'm going to backtest to 10/1/2019 and then I'm going to go into Searchers, Single Strategy, and you'll see right here, Married Put Ranker. All right, this is a simple ranker to use. I'm going to go ahead and go after the S&P 500. If you're building portfolios of stock, it's always a good idea to use the S&P 500. That's where the institutions play. These are the most healthy stocks, the biggest stocks in the market, and they have consequently more chance of going up as a whole. All right, so we're going to go against the S&P 500. I want to select highest probability of touch. So this is going to sort by the stocks that have the highest probability of touching a percent to double. All right, that's it. And then I click my search button. Let's take a look and see what comes back here. Once the scan comes back, let's take a look at the results. You get the stock, various information about the stock, the chart, implied volatility news, close price strike, expiration of the actual protected put, the cost of the put, various other information. We've also got the cost of the position, including the long put, and we've got the probability that this will exceed a percent to double, so the probability that you'll make more than a double. You've got days to expiration as well as the earnings date. You've got your married put percent to double. This 6.74% means that the stock needs to rise 6.74% to double your risk in this trade. We also have probability of touch. This is what I've sorted by. Right up here, I did specify that highest probability of touch. So you'll notice here that this one has a 72% chance of doubling our risk. So let's pull up the actual trade by clicking the put price right there. And this is the trade that we get. So let's take a look and see exactly what we have here. So we have 100 shares of stock at 166.46. That was the closing price on October the 1st. And then we bought a put. Now we buy one put for every 100 shares of stock. All right, so this one put is going to cost me $738. And because the stock is trading for less than 170 at 166.46, we've actually overinsured the stock so that our actual risk in the trade, because we can sell the stock at 170 anytime we want, the actual risk in this trade has been reduced from potentially $16,000 $646 all the way down to $384. Now notice, of course, that your debit is still the same. You still got to buy the stock, you still got to buy the put, but the risk is limited because we're buying insurance at 170. All right, so let's see what happens with this one. I'm going to move it forward 1 month to 11/1, and notice what's happened here is that the stock has risen quite a bit. So this particular directional ranker did a good job in this particular case and found a stock that was really moving up big. We do have earnings coming up in 4 days. Not always a good idea to hold a position over earnings, but if you have a protective put, maybe it's not such a bad idea. All right, so here's what you want to do though. Because the stock is now trading at 178, you may want to move your put up to 180. So this is called rolling a put up. Let me show you how to do that. You click edit, and this will pop us into the edit screen. And what I want to do is sell my December 20 put. So I'm going to come down here and I'm going to sell one December 20 put. The strike price that I'm selling is 170. And I'm going to take the market price, and then I'm going to buy another one. Let's keep the same amount of time, the same expiration date of December 20, and I'm going to raise my put strike to 180. So what I'm doing here is I'm selling my 170 put and I'm buying my 180 put, same expiration month. So I'm rolling up my put from 170 to 180. Let's take a look and see what the risk graph looks like when I do that. And now what you'll notice is something very beautiful indeed. You see here that we have a guaranteed profit of $338 on my position. So here's my risk graph. It looks like a long call risk graph, and that's because stock plus short put equals a synthetic long call, and we have no way of losing any money on this trade as it stands. So that's the power. Once the stock moves your way, you lock in profit by buying a protected put. Now, in the event the stock tanks from here, it's possible the stock could drop all the way down to, gosh, 162, let's say. What's going to happen is I'm going to lose money on my stock. In this case, with the stock trading at 178, if the stock's at 162, I've lost $16 per share times 100. That's $1,600 that I would have lost had I not had the put. So what I could do in that case, if I want out of the position, is I could simply sell my stock and sell my put, or I could exercise my right to sell the stock at 180, and that's what the 180 put gives me. Now, the other thing you could do is if you wanted to hold on to the stock, you could sell the put that gained in value to offset the stock price tanking, and you could roll the put down as well. So that's another option for you with this married put strategy. So in summary, here's the married put ranker, a very simple ranker. The first thing you do is click S&P 500 as your stock list, select highest probability of touch. You can also select these others if you'd like, hit your search button, and then start moving through the stock. Make sure you like the stock, apply any technical analysis that you see fit. Remember that the probability is already behind the scenes based on what the scanner produces. You may also wish to incorporate collars, which I've talked about in a prior video. All right, there you have it. The married put ranker is a ranker that goes out and finds directional opportunities for you. I've talked about how you can manage these puts, how you can lock in profit if the stock moves your way, and then keep that profit going forward. Be sure to backtest and practice with it if you like this ranker or any of the other rankers. Have fun with it, and I'll see you next time.